So you may have heard that after the budget that many pensions are due to be within the estate for inheritance tax from 2027. This has led me to consider for all my clients, what is the perfect amount to hold in pension assets now? I've been going through dozens of cash flow plans in the past few weeks, and I think I've figured out something. And this is where the process of understanding how you could potentially work this out is going to be more important because it's going to help you manage the tax wrappers going into retirement. If you don't know me, my name is George Agan. I'm a chartered financial planner. I've helped thousands of people retire without worry. And in this video, I'm going to show you how to calculate your optimum pension size, what this means for your retirement planning, and most importantly, the strategy that you can use to avoid inheritance tax entirely, potentially. So just to recap quickly, under the current proposals put forward by Rachel Reeves and the recent budget, if someone dies after the 6th of April 2027, most death benefits for pensions will be included within their estate for inheritance tax. The consultation paper confirms this will apply to all residual defined contribution funds, that's flexible funds, whether in drawdown or uncrystallised, defined benefit lump sum death benefits, so not the spousal provision, annuities where there is a survivor's death benefit, and lump sums from pensions in payment with things like value protection. That's basically where you inbuild the annuity to have an additional extra benefit. There's also other things like trivial commutation, lump sum death benefits, that's pensions under 30 grand, but we're going to park that. Anyway, these will be in the estate regardless of whether the scheme administrators, trustees have discretion over the payment of death benefits or not. That was originally what kept benefits outside the estate for inheritance tax. So this is a big change to the pension landscape. It's very important to bear in mind though that the spousal exemption applies still. If you leave your pension to a spouse or civil partner, inheritance tax won't apply until the second person dies. This is an important point for later because in reality, there's statistically a 51% chance that one person in a couple, if they're both 65, will live to age 90. While no one's lives are a statistic, the length of time you have is a key variable in retirement and legacy planning. So this should be a really important part to bear in mind in your plan. And just before I go over the optimum pension pot size, I want to just go over why pensions still are very efficient savings vehicles, and they will still be front and center for retirement planning for my clients and for me personally, despite the fact that they are due to be within the estate for inheritance tax going forward. And I think we need to focus on that. So just to recap, there are lots of rules around the edges here, and I've done a full video on that if you want to catch up on that. But pensions in general receive relief at marginal rate. Now that could be 20%, 40%, 45%, or potentially 60% if you are caught by the £100,000 tax trap. And watch this video if you don't know what I'm talking about. The key advantage in pensions is the relief you get now, the growth free of income tax and capital gains in the interim period, and then the effective tax rate at the end, basically the tax you pay on extraction. With capital gains tax now increasing, the use of tax efficient wrappers is going to be really important. For example, if you take £100 from your pension, you receive £25 tax free and the rest is taxable. If it's taxable at 20%, that means you'll pay £15 in tax. So the effective tax rate of that £100 withdrawal was 15%. So one of the big misconceptions which is lost in all the noise around pensions are dead and all that nonsense is that the maths of this exchange, the relief on the way in versus the effective tax rate on the way out, remains unchanged. I'd also make the case that if you are worrying about your pension causing an inheritance tax issue, there's probably a decent likelihood that you're a higher rate taxpayer or above. So we shouldn't give up great lifetime tax advantages over the fear of a hypothetical legacy tax. And I'm going to explain in a second why that's so important. Anyway, the key insight is that nothing has changed in this exchange. But if pensions are going to be inside your estate going forward, we need to get more strategic about the relief now versus the effective rate on extraction plus potential legacy. Just a quick recap. No inheritance tax is paid on any estates within the nil rate band, which per individual is $325,000. There is also £175,000 extra if a main home is left to children or direct descendants. The inheritance tax above that is at 40%. However, you can join your inheritance tax band with your spouse, which gets you up to $1 million. And also, if your spouse passes away and you leave all your assets to them, there is what's called the spousal exemption. So inheritance tax is typically only paid on second death when that's the case. There's also sometimes provision for gifts if they're made within 7 years before a death. But any time after that, they're typically outside the estate. There are some exceptions, so please seek advice. And there are some annual gift allowances as well, which I'll come back to. So that's a very super high level overview, but now let's get tactical. I mentioned effective tax rates. Let's just focus. Your effective tax rate in retirement, which does impact your optimal pension pot, is going to be impacted by when you retire. So for example, if you work part-time, you're going to potentially continue to earn and have more income in your tax bands. It will just give us an idea of how much within the allowances we have to work with. There might be other sources of income as well. So perhaps you might have rental income or perhaps a defined benefit pension in payment. There's also going to be the state pension later, which if it's full is actually going up next year to £12,016 from April 2025. So that's basically going to use almost all of the personal allowance of £12,570. That's the new state pension. Old state pensions can be slightly different. So understanding this to begin with will give us an idea of how much room you personally have within tax bands. So if I've got a client who's doing consistent non-exec roles in retirement, or maybe having a big defined benefit pension, they're going to clearly have much less scope to use bands effectively as someone who may be retiring at 60 or 55 and have no other income. So the bands at time of recording are 12,570 as your personal allowance, 0%. Then from 12,571 up to 50,270 at 20%. Then beyond that, you're going to get 40%. And then if you're above £100,000, you could potentially lose your personal allowance. And there's a 45% rate band above that. I'm not going to focus on the higher rates because I think for most people, that's unlikely to be an issue in retirement. So let's just focus on the lower bands up to basic rate. So let's just say tactically, you were looking at your pension going, okay, how am I going to take money out of that pension in a tax efficient way? Well, the one thing I've been thinking about is you could potentially take, let's say you've got no other income and you're at 60. You could potentially take £67,026. And of this, £16,756 is tax-free cash. £12,570 is taxable, but it's going to sit within that 0% personal allowance. Now the residual, the £37,700, is going to be taxable at 20%. Now that means a tax of £7,540. So if we flip that £7,540 back to the total rate taken from the pension, £67,026, you can see it has an effective rate around 11% or 11.25. So this really just reinforces my point where if you get high rate relief and maybe in the national insurance savings and you get 42% tax relief, 40% income, 2% national insurance, then there's still a huge disparity on what the tax relief you get in versus the tax rate on taking out. But how do we calculate the perfect pension pot size for you depending on your retirement journey? Well, it is very individual, but this is where cash flow planning comes in. And it can really give us an idea of the maximum tax relief you could have at lower rates. So let me illustrate this with an example. I'm going to give an example of John. He's come to me and said, should I stop contributing to my pension? He's someone who you could argue is going to get hit hard by these changes in rules for inheritance tax. He's divorced. He has a home worth $500,000, which conveniently is exactly within the nil rate band of 325 and the main residence nil rate band of 175. He wants to leave his assets to his kids eventually if something happened to him. And he's very worried now because he's got quite a sizable pension pot and he's already maxed out his nil rate bands. And he's understandably saying to me, I've saved all my life. And now I'm really worried because of these changes in rules that HMRC are going to be one of my biggest beneficiaries. He's come to me and said, should I just stop contributing? Am I just wasting my time doing this? So what we do with John is we use cash flow planning. And we firstly have a look at, hypothetically, based on his retirement plans, what would he have to take out if he wanted to max out his basic rate bands throughout retirement, effectively never pay a higher rate. So John is 55 now. He wants to retire at 60 with no other income sources. He's got his full state pension. And based on his investments, I'm going to just assume a 5.5 nominal rate of return after charges. And I'm going to assume 2.5 inflation. These assumptions will vary from person to person depending on their risk profile of the investments. But the specifics here are irrelevant, frankly. It's the process which is important. One of the variables here that I'm really shaky on, or I'm not very confident on, is the position around inheritance tax increases going forward. In theory, all bands should increase with inflation each year. If they don't, they're a self-tax. As wages generally rise in line with inflation, or bills certainly do, and if the bands don't increase with inflation, then people get dragged into these higher tax bands over time, including inheritance tax bands. Now, inheritance tax bands have been frozen and are going to be frozen until 2030. And they haven't increased since 2009, 2010. So that's 20 years that they haven't increased. That is ridiculous, to be frank. And it's no wonder that more people are going to be caught by these inheritance tax thresholds. As a planner, you have to use the rules at the time. You can't make stuff up. So I'm going to assume the government holds true to their word, and from 2030, we get inflation increases to the inheritance tax bands going forward. What I can do then is I can cross-reference this with the expected growth rate of his property and his pensions, factoring in these withdrawals. You can see here, we've got till 2030, the band he's going to have for inheritance is going to be 500,000. And then I put the figure up here for 75. So remember, we're quite confident that he's going to be paying 11 to 15% on tax, on effective tax rate on extraction, which is a good result because most of his contributions have been relieved but 40%. Now, these expenditure amounts I've set, they're arbitrarily set to max out the basic rate. They're not necessarily John's need. And there's actually quite a key insight with this, which is because these withdrawals have been set up this way, because we are trying to draw down on the pension, they actually would then fall, if they were above what John actually needed, as surplus income and typically expected to be under what's called the normal expenditure out of income inheritance tax threshold. I'm going to go over this in more details in another video, and I have actually, if income is of a certain amount that it doesn't reduce your quality of life and it's from income, not capital, so it can be regular pension payments, then it can potentially fall in the normal expenditure out of income rule and be immediately exempt for inheritance tax, not part of a 7-year rule. So this would be ideal for the kids. We could say, why doesn't that give you an opportunity to give money with, and I don't really like this phrase, but with a warm heart instead of a cold hand. Bit grim, that last bit, but you know what I mean. It's so much nicer to be able to give money while you're alive to see your kids enjoy it and maybe, help raise their kids, then potentially wait till 85, 90, and then just give them a big lump sum. Now, for the normal expenditure out of income rule to apply, the advisor and John would have to keep good records of the habitual gifts because it could potentially be challenged by HMRC at some point, so you have to make sure that you've got good records. But they're not part of the 7-year rule. And you can actually use this, if you needed to, in combination with the £3,000 annual gift amount. Okay, so what I'm going to show you now is just a bit of a cash flow plan, and I'm going to show you how you can kind of use the magic of a cash flow modeler to work out effectively how much a pension pot would need to be based on a ton of assumptions. So just very simply, here we have John as an example, and I've run it specifically to 86. Now, ONS life expectancy is 84, but I've run it to 86, just slightly past it, just to be a little bit safe. And what we've done is that while I would run all cash flow plans to 100 as a safeguard, I've done this specifically as kind of a starting point for a reasonable assumption on when a male who's age 55 could expect to live based on ONS stats. So this isn't saying that the plan would last throughout all that, it's just to say this is a stake in the ground. You can see he's working at 55, he's got retirement at 60, state pension at 67, and then 75, just put that down there in the market because of the death benefit changes. Now, what I have included is I've included just the state pension. And for the sake of ease, I've just assumed the state pension is sitting in the personal allowance at 12,570. It's super high level at this stage. We're not looking for total precision here. We're just looking for generally a good guide. And what I've then done is I've effectively put in a withdrawal each year of £67,026. And that would basically mean that when you factor in tax-free cash, the full withdrawal will be sitting inside the basic rate, effectively. And then that would increase with inflation going forward, you can see here. So because I've not put any other pension value here, you can see the blue line, we've got the state pension kicking in, we've got in the red with the additional required withdrawal, and it's increasing over time. So this is cash flow is effectively just telling me, where's the money? Now, what I can do is I can then use one of these insights, and it's called a lump sum saving insight. And what this insight effectively does is it goes, okay, you want this level of income over time, inflation increasing 67,026. What is the lump sum you would need today as a 55-year-old to potentially provide that level of income over time every year till your 86th birthday? So from 60 to 86. So all I'll do is I'll just let that calculate. Now, the only one downside with this is that the lump sum assumes it goes into an unwrapped investment. So what that would mean is that would mean effectively I would have to uplift this by the assumption on the effective tax rate, which was broadly 11%. So this 989,453, I would actually have to uplift this slightly just to factor in tax because of the pension, because the pension does have some tax on withdrawal. So I'm just going to do that very quickly. So that's given me 1,111,744. And you can see there we're just at 86 there. before we hit a shortfall. Basically, what that's telling me that, well, theoretically, unless your pension, John, is worth 1,111,000, you could still withdraw from that fund at a reasonable effective tax rate and still be much better off via the pension. And I can kind of reverse engineer this. So let's say I've got the SIP here. Now, I've intentionally put charges down as 0 just because I've left simple assumptions on the 5.5 growth rate. So the growth rate is assumed at 5.5 here. And let's put that figure in, which is not going to be perfect. And let's see how it works out. So there you go. Yeah, you can see that we're give or take there. Now, it's not going to be perfect. And you can see the assets are drawing down. Okay, the thing that's really interesting about this is, let's say it became clear that he had overfunded his pension. What we could do is we could jump in and go, okay, well, what would the impact be if we move you forward a year or two? You know, what happens if you go, okay, I've overfunded my pension. Let's just retire slightly earlier. So then we go to Insights again. We'll have a look at the lump sum required to meet those goals. And you can see now we're slightly higher. And just remember, the withdrawal target is basically the target for maximizing the basic rate bands. So it's basically saying that that's the amount that we can withdraw time and time again to ensure that you're making the very most of your basic rate bands. And there you go. So it was 15% on the current rough and ready calculation. And as you can see, 86, money goes. And we're 100% there. So the key thing that I'm trying to just explain here is that you can absolutely calculate, based on your assumptions for retirement, your other income sources, what is the pension amount that you can potentially build up and still have a very tax efficient withdrawal. Now, what I've done also as well at the bottom in the non-liquid is I've also included the value of the home, but I've increased it by 2.5 each year with inflation. So what we can do now is we can go, okay, at the 74th birthday, we're expecting the total amount of the pension remaining at 1.231 million. The inflation adjusted value of the home after that, that period of time is going to be worth 819,000. So that is basically 2,050,988 is the projected value at that particular cliff edge. And now I'm going to put up very quickly what we're projecting the increase in inheritance tax thresholds are going to be. See, we can use these projections to figure out how much of an issue it's going to be at a certain point. And for those of you who are mathematically minded, you can now figure out, if you know roughly what the figure is that you require it to be at 60, you can then speak to John about his current contribution rate and discuss whether additional contributions or current contributions to a pension are advisable. It's important to bear in mind under that normal expenditure out of income rule, though, is that we do get caught if John were to pass away immediately, unexpectedly. But theoretically, let's even say the withdrawals were at 40%. If withdrawals cause 40% income tax, but actually then they fall in the normal expenditure out of income rule, that is effectively offsetting the 40% inheritance tax band. So I just want to focus on the fact that there are levers that we can pull here to make sure that we mitigate inheritance tax. Yes, things aren't as advantageous as they were prior to the budget, but there is still lots of scope for good planning. And I just want to go into the reasons why I don't think John should be particularly worried about passing away early. But if you are finding any of this interesting, why not sign up to my email list? In doing so, you get a free ebook, 5 pension tax mistakes to avoid. You get regular updates from me on strategies and tactics I'm using with my clients to make sure they retire without worry. I run specific workshops for my clients, which you'll get access to from the email list. And actually, if that's not enough, I'm also designing a cash flow model in Excel, which I'm giving away free for my subscribers. Your data is never shared, and you can, of course, unsubscribe at any time if it's not valuable to you. So the link is in the bottom if you're interested. Okay, so John came to me really worried about inheritance tax and pensions. I'm going to give you 3 reasons why I don't think you should be particularly worried. The first is that we just can't ignore the statistics. If you're a 55-year-old, there is a 1 in 4 chance you'll get to 92. I appreciate, because I know you'll probably get it in the comments, that he, like any of us, could get hit by the proverbial bus or a health issue. But you know what? There are sometimes tax-efficient times to die and sometimes less so, but I'm yet to meet a client who thinks dying to save tax is a good idea. So let's work on probabilities, not hypotheticals. And the statistics are, if you're about to retire, there is lots of time to plan. The second, if John were to die before age 75, with the current example with a flexible pot, under the current rules under the proposal, while there could be an inheritance tax charge, any residual defined contribution funds will be tax-free for his kids to draw on if he died before age 75. So I think you can actually make the case that until age 75, the tax position isn't that bad. I'll put on the screen now just a bit of a calculation of his projected estate if he were to die at age 74, and the effective tax rate on the basically the tax he's paid versus the value of the estate and what it would like to be for his kids. And of course, it's not ideal ever to pay tax to HMRC on inheritance tax, but they're still going to get a decent residual estate. So they're the kind of the things that I would do to temper the concerns. But the third reason, if that wasn't sufficient, then, and John was absolutely sound stone making sure his kids didn't pay a penny of inheritance tax, we could just consider insuring that liability, basically saying your pension fund is quite high. That means it's going to give us a reasonable income. There's no reason why we can't use some of that income to fund an insurance policy. And there are three kind of strategies with insurance policies we could consider. I'm only going to mention this briefly because I'm going to do a whole video on a more in-depth planning strategy here, but you could consider what's called a whole of life policy. This is going to be more expensive because it's guaranteed to pay out, but as long as you continue paying the premiums and you can get them on a guaranteed basis, typically so they don't increase over time, then you know that you're going to have a certain amount which can be written in trust to pay an inheritance tax bill outside the estate when the time comes. Because let's be honest, we're all going to pass away one day. Now, you could consider it as a more complicated gifting strategy and run what's called a decreasing term assurance policy to a certain date. So these are very similar to what you have to cover your mortgage, and you can customize how much they go down over time. These will be cheaper than whole of life because the cover reduces over time. And the downside is that they generally only run to a specific date. You can get them till much later in retirement, but they become very expensive, understandable. But the benefit of that kind of insurance over time is that you could run it alongside a gifting strategy. So you go, okay, maybe I'm going to run it till 82, which is 7 years after I turn 75. And I'm going to use that in combination with my cash flow plan to go, okay, I'm expecting my pension value to be this, the inheritance tax value is going to be this, and I'm going to have this policy to run alongside it. And at the point of 82, I'm expecting the liability to be quite low. So while I will have had to pay the premiums, I also then have the cover should I pass away early. And finally, there are specific policies called gift intervisos, I think I pronounced that right, which are actually designed specifically to cover the 7-year rule gap. So what happens is that the cover tapers over 7 years, so it covers an inheritance tax bill. Again, I'm going to do another video where I dive into this in a bit more detail, so I'll just leave it at that for now. Anyway, I hope that's just giving you a flavor of the areas that I'm considering with my clients to manage both their lifetime and legacy taxes. But what I haven't really done in this video is explain in depth how the pension death benefits will work in this new regime, answering questions like who exactly pays the inheritance tax charge if I die, and what rules remain the same since the budget and what have changed. If you're interested in that, maybe give this video a watch because I think it's going to help guide your decisions in later retirement. Either way, thanks so much for watching and look forward to seeing you on the next video.